What is going on, investors? My name's Emmanuel, and apologies, it's been a couple of days since I last uploaded a video. And truthfully, the reason why I haven't is because I have been working overtime at the clinics because I've been trying to get my cash pile up. That's the long and short of it. I believe we're going to see even further declines. And one of the reasons why I believe that is because I've been studying about the PE ratio over the last century or so, and we are we are in scary territories right now. And I have been buying, but I think I've been buying a bit prematurely, because just looking at the PE ratio, we are in for a serious correction, in my opinion. So in this video, I'll tell you what I am seeing in terms of the PE ratio, what my predictions are for the market going forward. I'll also run through all of the acquisitions I made last week, including a brand new company that I started investing in because the company missed on earnings. Even though overall they had an incredible 2020, in Q4 they missed on analyst expectations, and as a result the share price did get hit quite significantly. To be fair, it's been overvalued anyways, but the share price did get interesting and I did start a position in that company. So I'll be telling you what that company is. But before we dive into all of that, don't forget to smash the like button, hit the subscribe button and the notification bell if you want to see all of my latest videos. Plus, if you want to know what I'm buying and selling in real time, you need to join my Discord group via the Patreon link in the description below. However, wait till the 1st of April because that way you can get a full month. So with all that said, let's dive into it. Okay, so here is the PE ratio over the last centuries. So from 1880 to where we are now in 2021. Now, Peter Lynch was talking about the PE ratio back in the 80s and the 90s, and he was saying the typical range is between 10 and 20. And as you can see, from 1880, it pretty much was in that range for over 100 years. And Peter Lynch said once the PE ratios start to drop below 10, that's an indication that the S&P 500 is undervalued and represents the best time to buy, which, if you look at it, does make sense. So the 1950s would have been a great time. Before the 1920s as well represents a great time. If you watch my previous video about the market dropping, you would know that the 1970s was one of the worst eras to be investing because the market just was on a decline for pretty much the whole of the 70s. But the best time to have bought shares was in the 80s, and that was when the PE ratio for the S&P 500, as you can see, was undervalued. And it's continued higher really ever since. Looking at the table now, you can argue that the threshold for being overvalued and being undervalued has increased. And I would probably go on to say that it's now between 20 and 30 because the PE ratio of the S&P 500 has not been below 10 for the past 30 plus years. So experts and analysts are now saying that the new range is between 20 and 30. And as you can see here, right before the dot-com bubble, the PE ratio of the S&P 500 was regarded as being overvalued. And then, as you know, afterwards, the dot-com bubble, it crashed and the PE ratio did drop. But it did see another spike in the early 2002s, 2003s. And then, of course, it crashed even lower, back down below 20, which we can now say is the S&P 500 being undervalued. But going into 2007, 2008, as you can see, a massive rise to 65. And then we all know that led to the financial crisis, which lasted for about 2 to 3 years. And then the PE ratio sharply shot back down. And between 2010 all the way to about 2015, you can argue the S&P 500 at that point was undervalued. And here's where we are now from 2020 to 2021. We are again massively overvalued if you are looking at the PE ratio. So what do I expect to happen from where we are right now at a PE ratio of 40.47? I do expect to see a pullback below 30. Ideally, now in the perfect world, if we can pull back all the way to a 20 PE ratio, which I honestly don't really see happening, that would be fantastic. But even if we drop below 30, that would be great. That would be great because that means most of the S&P 500 will go on sale, especially a lot of the companies that are currently overvalued. They're going to see a massive decline, a massive correction, and that represents great buying opportunities for us. So this could be either good news or this could be bad news, depending on what side of the fence you're sitting on. But for me personally, this is great news. But for those who are looking for profits now, this is probably bad news. And it's probably a good time to start taking some profits off the table. I mean, you've got to look at Goldman Sachs. Goldman Sachs recently sold $10.5 billion worth of stocks in a block trade spree. They started selling off some of their Chinese tech stocks. They also started selling off some of their US media conglomerates. And they are liquidating. Goldman Sachs, they're liquidating some of their stocks, some of their positions. And sometimes it's a good idea to just follow the big money. If big money are securing some profits, then it might be a good idea for you to also start to think about taking some profits off the table. So this is the buy and sell alert channel on my Discord. And as you can see, last week I was busy. But to be honest, a lot of my purchases were more nibbling. So I picked up 100 shares of GoPro here. I picked up 25 shares of PLTR. I averaged up and picked up 70 shares of BlackBerry, picked up another 50 shares of GoPro here. I was alerting everyone when everything was down pre-market. I was like, yo, so many deals right now because, you know, red days get me very excited. So I was pumped. And I went shopping. I went shopping last week, picked up another 50 shares of Palantir, picked up 50 shares of Tattooed Chef, 50 shares of Osprey. I picked up some more Bitcoin on the 26th of March. So I was on a spending spree last week, and this has had a major impact on my portfolio. So we'll go through all of the purchases now, but this is my brand new acquisition. The company is called CELH Holdings. And right now I own 115 shares of their company. It's a startup position for me because I still wanted to do some more research. But I did like the price that Celsius was trading at, because if you look at the 120 moving average, which is the main indicator I use for the mid-range cap stocks. So the share price was trading at about $70 a share, which at the time I thought was a bit ridiculous. When they announced the earnings on the 10th of March, the share price took a dump, at one point over 40% off its highs. And I felt this was a great time to at least start a position in the company. And that's exactly what I did. So right now my position, I'm up about 1.1%, $56. But I do plan on adding to this position. Now, if you're not familiar with Celsius, they're an energy drink company. So their main competitors are the likes of Red Bull, the likes of Monster, the likes of Rockstar Energy. Those are their biggest competitors. However, in their Q4 earnings call, which I broke down for my Discord members, the company's e-commerce sales growth on Amazon alone grew by 177%. And that was by the 13th of February, 2021. And its next highest competitor, which grew that quickly, was Red Bull, and that was only at 14.8%. And in third place was Monster Energy Drink. So this company is growing at an insane rate right now. Their domestic revenue grew by 67%. Their fitness channel revenue in Q4 grew by 22%. Their international revenue grew by 3%. And their Nordic revenue grew by 2%. And the company's overall year-on-year revenue growth for 2020 was an insane 73%. And I shared with all my Discord members that this company is definitely worth having on your watch list. And for me, it reached a price where I felt it's a great time to start a position. And then if we're lucky enough to see further dips, I will be adding on these dips. Now, next up was AMD, and I added 50 more shares to my current AMD position because the share price has broken through the 200-day MA and has continued lower, and I figured let's start nibbling. So right now I have 110 shares of AMD in my portfolio. My position is down by 0.6%, but I am not too worried. It's a company that I absolutely believe in long term. They have an incredible business model. They have incredible financials. And I do think despite them having a great quarter, investors are getting worried because of the moves that Intel have been making recently, but it's not affecting me. I know what I own and I know why I own it. Now, next up was BlackBerry. I believe I picked up an additional 70 shares of BlackBerry because it's been selling off hard. I'm now sitting on 950 shares of BlackBerry. It represents 4.5% of my hyper growth portfolio, and the position is down about 3%. But again, BlackBerry is another company that I am absolutely bullish on. People are sleeping on BlackBerry's IV system. And I shared this with my Discord that I will admit I still haven't grasped the full potential of IV and its integration with AWS automotive customers, so the likes of Toyota, BMW, and VW. And that includes vital data from roughly 175 million cars on the road. And right now, a lot of the value that Tesla holds is their data information. I think a lot of people are sleeping on BlackBerry's IV system and the amount of data that they're going to be able to collate within the next couple of years. I'm a buyer of BlackBerry sub $10, sub $9. I am loading the boat. So that's my position in BlackBerry. So next up was GoPro, ticker symbol GPRO. And I only picked up 170 shares of GoPro. It's because I want to keep my average below $10 a share. So my average at the moment is $9.47. I'm currently up about 25% on my position, so that's about $9,000. However, GoPro is becoming quite large in my portfolio. It weighs about 22.9% of my hyper growth portfolio. And like I did say in my previous video, it's now become my largest position. Will I start taking profits? I don't think so. I really do believe it's still undervalued, but judging by the PE ratio and what I think is going to happen, it might be a good idea to start trimming some profits. I'm still 50-50 with GoPro at the moment, but we'll see. I'll keep you updated if I do eventually sell some shares. But of course, if you want to know if I do and when I do, you need to jump on my Discord. Next up was Palantir. I was just nibbling in Palantir. Overall, my nibbles equated to about 100 shares additional of Palantir, and we're now sitting on 1,250 shares of Palantir. I'm down about 7.6% because my cost basis is $24.45. So it's quite high, especially in comparison to a lot of other people, but I am very bullish on this company long term. Currently, it weighs about 13.9% of my hypergrowth portfolio, and I have no problems with that. So those are all the acquisitions that I made. Like I said, a lot of it really was mainly nibbling at this point. Let me know in the comment section below if you went shopping, and if you did, what did you pick up? But with all of that said, none of this is financial advice. Please make sure you do your own due diligence and your own analysis before you decide to invest in any company or in any stock. Remember, I'm not a financial advisor. If you do want to learn about investing in stocks, there are some useful links in the description below. With all that said, I hope you have a great week. Thank you so much for watching, and I'll catch you in the next one. Peace.